You put $100,000 into the market. 10 years later, one investor walks away with $287,000. The other, $174,000. Same starting amount, same decade, a $113,000 difference. The platforms were nearly identical. The fees, almost nothing. So what went wrong? It wasn't the broker, it wasn't the market. It was something most investors never see coming, and it happens in the first 18 months. By the end of this video, you'll know exactly what it is, and more importantly, how to avoid it. Here's what nobody tells you about investing. The biggest threat to your portfolio isn't a market crash, it's you. Specifically, it's what you do in the 547 days after you invest. Most people think the hard part is choosing between Vanguard and Schwab. It's not. The hard part is not touching the account, not checking it every morning, not panicking when it drops 12% in a month, not pulling out when your neighbor brags about his crypto gains. The market rewards patience, but your brain punishes it every single day. Let me show you how this plays out in real time. You open your account, you transfer $100,000, you buy a simple index fund. So far, so good. Month 1, you're up 3%. You feel smart. You check the app twice a day. You tell your spouse it's working. Month 4, you're down 8%. You feel anxious. You start reading financial news. You wonder if you should have bought individual stocks instead. Month 9, you're up 1% total, barely. Your buddy just made 40% on Tesla. You feel stupid. You're bored. Nothing's happening. You think, maybe this passive investing thing is overrated. Month 18, the market drops 15% in 3 weeks. You're down $18,000 from your peak. You can't sleep. You sell half your position just to protect what's left. And that's where you lose. Because the investor who does nothing, who doesn't sell, doesn't trade, doesn't react, ends up with $287,000. And you end up with $174,000. The difference isn't intelligence, it's not luck, it's emotional endurance, and most people don't have it. Your brain wasn't built for investing, it was built for survival, and survival means avoiding loss at all costs. Here's the problem. Your brain treats a 10% portfolio drop the same way it treats a physical threat. Cortisol spikes, heart rate increases, you feel danger, and your instinct is to run. But running in the market means selling, and selling locks in losses. The very thing you're trying to avoid, you guarantee. This isn't theory, it's neuroscience. Loss aversion is hardwired. Studies show people feel losses twice as intensely as gains. A $10,000 loss hurts more than a $10,000 gain feels. So when your portfolio drops, your brain screams, "Get out! Stop the pain! Do something!" And doing something feels responsible. It feels proactive. It feels smart. But in investing, doing something is usually the mistake. Now add social pressure. Your coworker mentions he's up 35% this year. Your brother-in-law is flipping houses. Your friend is day trading meme stocks and posting screenshots. And you're up 6%. Boring, steady, unremarkable 6%. Suddenly, your strategy feels wrong. You start thinking, maybe I'm too conservative. Maybe I should take more risk. Maybe index funds are for people who don't know what they're doing. This is where most people break, not because their plan failed, but because everyone else's plan looks better. Here's what you don't see. Your coworker is cherry-picking wins. Your brother-in-law isn't mentioning the deal that fell through. Your friend isn't showing you the losses. You're comparing your behind the scenes to everyone else's highlight reel, and it's killing your returns. Because the moment you abandon a boring working strategy to chase performance, you reset the clock. You buy high, you sell low, you start over, and compounding, your most powerful weapon, stops working. Let's talk about something investors never admit. Investing is boring, painfully boring. You set up automatic contributions, you buy a total market index fund, you wait. That's it. No drama, no excitement, no daily wins to brag about. And boredom is dangerous, because boredom feels like nothing's happening. And when nothing's happening, you assume you're doing it wrong. So you start tinkering. You add a tech stock, you buy a trending ETF, you rebalance for no reason. You convince yourself you're optimizing. But every move introduces friction. Every trade has a cost. Every decision is another chance to be wrong. The best investors do almost nothing. They set it and forget it. But that requires accepting boredom, and most people can't. They need action. They need to feel involved. They need proof it's working right now, and that need destroys their returns.
Here's another killer: waiting for the right time to get back in. You sell during a downturn, you feel relieved. The market keeps dropping, you feel smart, you dodged a bullet. Then the market bottoms out and starts recovering, and you think, I'll wait for a pullback, I'll get back in at a better price. But the pullback doesn't come. The market keeps climbing, 5%, 10%, 15%. Now you're stuck. If you buy back in, you're buying higher than where you sold. That feels like admitting you were wrong. So you wait and wait and wait. Meanwhile, the investor who never sold is up 23%, and you're sitting in cash, watching. This is called timing the market, and it's one of the most expensive mistakes you can make, because the market's best days are unpredictable. Miss the top 10 days in a decade, and your returns get cut in half. Miss the top 30 days, and you barely break even. And those best days, they usually happen right after the worst days, when fear is highest, when everyone's selling, when getting back in feels impossible. People think active management means control. It doesn't. It means anxiety. Every decision you make is another variable, another thing to get right, another source of regret if it goes wrong. Should I rebalance now or wait? Should I take profits or let it run? Should I average down or cut losses? Should I rotate into value or stay in growth? Each question adds stress, and stress leads to mistakes. The investor who does nothing has one decision to make: stay invested. That's it. No rebalancing triggers, no profit-taking rules, no loss limits. Just patience. And patience is free. It requires no skill, no research, no intelligence, but it requires something most people don't have: the ability to do nothing when everything in you is screaming to act. Here's the most dangerous belief of all: I'm not like other investors. I'm rational. I'm disciplined. I won't panic. Everyone thinks this, and almost everyone is wrong. Because you don't know how you'll react when the market drops 30% and you're staring at a $30,000 loss. You don't know how you'll feel when your portfolio underperforms for 3 years straight. You don't know how you'll handle watching your friends get rich while you stay the course. You think you'll be fine, but your brain has other plans. And this is why platform choice, Vanguard versus Schwab, barely matters, because the real battle isn't external. It's internal. The investor who wins isn't the one with the best platform. It's the one who can outlast their own emotions. So we've covered why most investors fail. It's not fees, it's not bad funds, it's behavior, it's emotion, it's the inability to sit still while the market does its thing. But here's what we haven't answered yet. If behavior is the real enemy, does your platform choice even matter? Can Vanguard or Schwab actually make it easier to avoid these traps, or harder? And what about the numbers? If you avoid every emotional mistake we just talked about, if you're the rare investor who stays the course, does one platform actually grow your $100,000 faster than the other? That's what we're diving into next, because the answer isn't what you think, and it might completely change which platform you choose. But first, if this is making you rethink how you invest, hit that like button and drop a comment telling me which trap you've fallen into before. I read every single one. Let's keep going. So here's the question. If behavior destroys most portfolios, does your platform actually matter? Yes, but not for the reason you think. The difference between Vanguard and Schwab isn't performance. Over 10 years, if you buy the same index fund on both platforms and never touch it, your results will be nearly identical, maybe a few $100s apart. That's it. But here's what actually matters. Which platform makes it easier to do nothing? Because the platform that helps you avoid your own worst impulses is the one that grows your money faster, not through better returns, through better behavior. Let's break down what that actually means. Schwab's platform is beautiful. Clean design, real-time data, colorful charts, push notifications, news alerts, research tools everywhere.
It feels professional. It feels powerful. It feels like you're in control. And that's the problem. Every feature is an invitation to act. Every notification is a prompt to check. Every chart is a trigger to analyze. The platform is designed to keep you engaged, to make you feel involved, to make you trade. Vanguard's platform? It looks like it was built in 2003, because parts of it were. It's clunky, it's slow, it's ugly, and that's exactly why it works. There's nothing exciting to check, no flashy data to scroll through, no dopamine hit from watching real-time price changes. You log in, you see your balance, it's boring. You log out. Boredom is a feature, not a bug, because the less engaged you are with your portfolio, the less likely you are to touch it, and the less you touch it, the more it grows. Schwab's interface makes you feel like an active investor. Vanguard's interface makes you feel like a lazy one, and in investing, lazy wins. Schwab gives you options, thousands of them, ETFs, mutual funds, individual stocks, options, futures, crypto, fractional shares, automated portfolios, thematic investing, stock slices. It's overwhelming. And when you're overwhelmed, you make one of two mistakes. You freeze and do nothing, or you overcomplicate and do too much. Most people overcomplicate. They build a portfolio with 15 holdings. They rebalance quarterly. They tweak allocations. They chase themes. They think more choices mean better results. They don't. More choices mean more decisions. More decisions mean more mistakes. More mistakes mean lower returns. Vanguard forces simplicity. Their fund lineup is smaller. Their tools are basic. Their entire philosophy screams, pick 3 funds and never look back. And that constraint is liberating, because when you can't overcomplicate, you stop trying to. You accept simplicity. You buy a total market fund, maybe a bond fund, and you're done. Simple portfolios outperform complex ones, not because they're better, because they're easier to stick with. Here's what kills returns faster than fees. Trading costs, not the commissions, those are zero now. The hidden costs, bid-ask spreads, tax drag, opportunity cost, emotional exhaustion. Every time you sell, you trigger a taxable event. Every time you buy back in, you pay the spread. Every time you switch strategies, you restart the compounding clock. And these costs are invisible. They don't show up on a fee statement. They don't trigger a notification. They just silently erode your wealth. Let's run the numbers. Investor A buys a Vanguard Total Stock Market Index Fund, holds for 10 years, never sells, pays 0.04% expense ratio. That's it. Investor B buys the same fund on Schwab, but checks it weekly, sells during 2 downturns, and buys back in later. Rotates into a tech ETF for a year, rebalances 4 times, also pays 0.04% expense ratio on the core holding. On paper, same fees. In reality, Investor B paid thousands in hidden costs, capital gains taxes, missed recovery days, suboptimal re-entry points. After 10 years, Investor A's $100,000 is worth $287,000. Investor B's, $214,000. Same platform options available, different behaviors, 73,000 difference. The platform didn't cause this, but Schwab's design made the behavior more likely. Now let's talk about the thing that most investors don't truly understand until it's too late. Compounding doesn't feel like it's working until year 7. Year 1, you're up $8,000. Nice, but not life-changing. Year 2, you're up $17,000 total. Decent. Year 3, you're up $27,000. You're thinking, this is slower than I expected. Year 4, market drops. You're up $21,000. You've lost progress. You're frustrated. Year 5, you're up $35,000. Feels like you're spinning your wheels. This is where most people quit, because 5 years feels like forever, and $35,000 doesn't feel worth the wait. But here's what happens next.
Year 6, you're up $52,000. Now it's accelerating. Year 7, you're up $71,000. Suddenly it clicks. Year 8, you're up $95,000. You're almost doubled. Year 9, you're up $124,000. This is happening fast now. Year 10, you're up $187,000. Your original $100,000 is now $287,000. Look at the pattern. The first 5 years added $35,000. The last 5 years added $152,000. Same time period, 4 times the growth. That's compounding. It's backloaded. It feels slow until it doesn't, and if you quit during the slow phase, you never see the fast phase. The investor who makes it to year 7 feels like a genius. The investor who quits in year 4 feels like investing doesn't work, but they were on the exact same path. One just stayed. Here's the cruel irony. The moment investing starts feeling like it's not working is precisely when it's working the hardest. When your portfolio is flat for 18 months, compounding is still happening. Dividends are reinvesting. Your contributions are buying shares. The foundation is being built. But you can't see it. You see a number that hasn't moved, and you interpret that as failure. Meanwhile, the investor who stayed through 3 flat years doesn't see the setup. They don't see the base being built. They just see the explosion in year 8 and think they got lucky. They didn't get lucky, they got patient. And patience has a precise definition in investing: continuing to do the right thing when it feels like it's not working. That's the skill. Not picking stocks, not timing the market, not choosing Vanguard over Schwab. It's keeping your hands off the wheel when every instinct tells you to grab it. So, let's reframe the entire journey. You're not investing to feel smart. You're investing to get rich slowly. You're not investing to beat your friends. You're investing to beat inflation and build wealth your future self will thank you for. You're not investing to win this year. You're investing to win this decade, and the next, and the next. And that requires a mental shift, because if you measure success by annual returns, you'll feel like a failure half the time. The market is up big some years, flat other years, down some years. But if you measure success by did I stay invested, the answer is always clear. Did you panic sell? No. Success. Did you chase performance? No. Success. Did you overcomplicate? No. Success. Did you stay boring, disciplined, and patient? Yes. Success. This is the game, and once you understand the game, platform choice becomes obvious. So who grows 100K faster over 10 years, Vanguard or Schwab? If you're a disciplined investor who never reacts emotionally, never trades, never panics, they're identical. Pick whichever interface you prefer. But if you're human, if you're prone to checking your balance, tinkering with allocations, reading market news, comparing yourself to others, Vanguard's boring, clunky design is your best friend. It's harder to trade on Vanguard. It's less fun to log in. It's less tempting to act, and that friction saves you from yourself. Schwab is a better platform for active investors, for traders, for people who want tools and research and real-time data. But for long-term buy-and-hold wealth building, Vanguard's simplicity is the edge. Not because their funds are better, because their platform makes it easier to do nothing, and doing nothing is the strategy that wins. So let's put real numbers to this. $100,000 invested in a low-cost total market index fund held for 10 years, assuming 10% annual returns, $287,000. Same $100,000, but you sell during one downturn and miss the best 10 recovery days over that decade, $174,000. $113,000 difference. Same fund, same fees, different behavior. Now, let's go longer. What if you stayed invested for 30 years instead of 10 years? $100,000 at 10% annual returns for 30 years, $1,744,940. But if you missed just the best 30 days spread across those 30 years, 30 days out of 7,500 trading days, you'd end up with $573,000. That's a $1.17 million difference from missing 0.4% of trading days. And those days are impossible to predict. They happen during crashes, during uncertainty, during the exact moments when selling feels smart. This is why staying invested isn't an option, it's the entire strategy.
Here's the truth that financial advisors won't say and investing gurus won't admit. Most of investing is waiting. Not researching, not analyzing, not optimizing, just waiting. Waiting through downturns, waiting through boring years, waiting through underperformance,
waiting while your friends brag about short-term wins. And waiting feels like doing nothing. It feels passive. It feels like you're not in control. But waiting is the work. Patience is the skill. Endurance is the edge. The investor who can wait 10 years will beat the investor who can't wait 18 months every single time, regardless of intelligence, regardless of platform, regardless of strategy. And the platform that makes waiting easier is the platform that wins. So here's what this whole comparison really comes down to. Do you want a platform that makes you feel like an investor, or a platform that makes you a successful investor? Schwab makes you feel like an investor. Notifications, data, tools, action. Vanguard makes you a successful investor. Simplicity, friction, boredom, inaction. Most people choose the first. That's why most people underperform. The smartest investors choose boredom. They choose simplicity. They choose the platform that gets out of their way and lets compounding do its job. Because investing isn't a competition with the market. It's a competition with yourself, your fear, your impatience, your need for control. And the only way to win that competition is to stop competing, to stop reacting, to stop trying to be clever. Just stay invested, stay boring, stay patient. That's the strategy. That's the edge. That's how 100K becomes 287K over 10 years, not through better platforms, through better behavior. If you made it this far, you're already ahead of most investors because you're willing to sit through 30 minutes of a video telling you to do less. That takes patience, and patience is the whole game. So if this changed how you think about investing, if you're realizing that doing nothing might be the smartest move you never make, hit that like button. Subscribe if you want more videos that cut through the noise and focus on what actually works. And drop a comment telling me, Vanguard or Schwab, which platform keeps you from sabotaging yourself? Because in the end, that's the only question that matters. Thanks for watching. Now go be boring. Your future self will thank you.